Hello, Arizona. Welcome to the Asset Preservation Hour with Stewart Willis. I'm Brad Johansen. Happy to have you all with us. Stewart, nice to be with you. Post-Halloween, did you survive everything?
Yeah, well, I had to unbutton my jacket here because I was about to blow apart the button off.
There's more holiday eating to come, so you need to pace yourself.
I'm trying, man. I'm trying.
We are beyond worried about sweets. We're worried about the market right now. It seems like every day you wake up and you've got some worse news. You got a take on where we are with the market right now?
Well, I think the one thing to remember is not to give into the clickbait. Oftentimes, you know, people click on things when they're scared, right? I mean, remember all of those news ratings during when Geraldo Rivera was riding those tanks into Kuwait there, right?
Wow, you're taking us back.
All right. It's because what we've realized is that these kind of fear tactics really scare people to watch,
sure.
Right? Look, we have 24-hour news channels that just look at the markets now, and if they don't keep you interested, keep you scared, then you're just not going to watch. You're not going to pay attention. But I think at the end of the day, look, we at the beginning of the year we saw a great market on the S&P 500. Kind of shot up, then it shot down. Third quarter was where it was, and then of course it pulled back. Yeah. Right? It was just kind of this seesaw we've seen back and forth. I think the fears that were going on earlier in 2023, even end of 2022. Revolved a lot around inflation. Those have subsided, so we don't have to worry about that. As a financial advisor, most of the competition we saw was, us versus maybe insurance companies or, other sort of entities like that. Well, now obviously banks are getting into the mix, right?
Sure.
With these higher short-term interest rates, this inverted yield curve. People are seeing CD rates at these tremendous rates that we haven't seen since, 2007 or so. So, it's giving people more options, but I think you want to make sure they don't miss the run of the market.
What about the bond market and where we are right now? I mean, conservative investors probably can't rely on bond market right now. Is there some other place to go with this?
Well, yeah, I mean, so the interest rate environment has posed a pretty interesting risk to those conservative investors because, look, year to date through the end of October, the market was up, the S&P 500 was up right around 8% or so, yet the bond markets were down substantially. So when conservative investors, they were penalized. They were penalized by it, and I would say over the last couple years, the classical 60-40 balanced portfolio certainly didn't work, and conservative investors got hit even harder. And it's interesting. I just had a graph made today, and what it's looking at is the last couple years of the S&P 500. And that's in blue there, the one at the top. So if you look over the last 2 years, S&P's down 8.5%, 8.46 through the end of October. That yellow line there is really interesting. That's the 7 to 10 year Treasury ETF from iShares. Its symbol is IEF. That's down 21.5%, wow. 21.43%. The 20-year Treasury TLT ETF is down 42.5% over 2 years. So what's that saying here, Brad?
Yeah, what's it mean?
Yeah, I think what it's saying is that conservative investors got hit harder.
Yeah. Right?
People that said I'm unwilling to lose actually lost more, which is the big irony and hypocrisy of the current environment. And I think we started to talk about, a year and a half or so ago that we are in the highest stock market in history. We're in the lowest interest rate environment in history. There's time there's things that we have to do to kind of divest that risk out of that low interest rate environment. And, we tried. We actually went, shorter duration on a lot of our positions. Our money managers all kind of saw the same way. Listen, nobody was immune from it. If you were in the market over the last 2 years, you lost money. It's just,
you had problems.
It's what happened. But I think that people need to find, that they need to have a portfolio that's right for them, at the right risk level for them, and they need to have a better understanding.
Okay, if I understand that there are now risks in the bond market that I didn't understand before, is there something for me to move forward on that?
Well, yeah. So what a lot of people did that were considering the same thing, they were concerned about rising interest rates. So in a low interest rate environment, they ended up going to fixed instruments, things like annuities, indexed annuities or fixed annuities. But here's the thing to look at. I'm going to pull up the 10-year Treasury slide here. This is looking at the 10-year Treasuries. What they did, you see that V on the right side there? That V is showing the bottom of the interest rate curve. Basically, interest rates for the 10-year Treasury in March of 2020 were down under 0.5%. 0.46%.
During COVID time.
Right. And so what ended up happening, Brad, is that people bought all of these fixed instruments during the lowest interest rate environment in American history. So they go and buy 10-year products. And listen, I generally think that the 10-year versions of those products are the best versions of them. I don't think you go longer. Those are just kind of commission drives from insurance agents. So if you bought an annuity over 10 years, I think it's usually pretty silly. The 10 year is kind of the sweet spot of where the good products are. The 3 and 5 year don't make a lot of sense right now because we believe that interest rates are going to shift back downward and we could see a shift. But for those people that said, hey, I'm going to take some chips off the table, I'm going to put some money, some safe money into one of these index annuities. Well, now they're 2-3 years into these things and they're not seeing any returns. Yeah. Right? Well, that's because a lot of them are using proprietary indexes that are based on bond returns. Not only that, they're also seeing an interest rate environment that they purchase them in that doesn't make sense. So if you bought your annuities during one of the lowest interest rate environment in history, you're not going to make any money. They are terrible, right? And it doesn't mean you did the wrong thing or your advisor was bad. It's that you bought them at the wrong time, but nobody knew interest rates were going to shoot up like they did. So, I have this kind of long-winded story. I've told the audience before, I have a son that's at college. He's off at UCLA.
Out of UCLA.
Yeah, we just got back from Parents Weekend, and it's an interesting thing because I was there a couple weeks earlier installing a TV in his fraternity, and it looked nothing like it looked last weekend here. Where the thing was immaculate when Mom and I went to go see it, right?
How about that? He prepped
2 weeks
for you.
earlier, man, it was disgusting. It was foul, this place. But, it's funny. After I went to go visit him, had a good time with some of his friends, when I flew back home, and by the way, my wife will say yes to this kid no matter what he asks. She just misses him. That's so much.
Mothers do.
Oh, guys, she knows the next one's going to head off to college in a couple years, and she's going to be devastated. But we used to have 1 million miles on Southwest Airlines, and he's used them all up to come back home every other weekend. So she'll say yes to him no matter what. But he called us right after I got back from there, and he said, hey, Mom and Dad, my friends want to come to the Phoenix Open, and hole 16. I mean, I live
about a mile. That's where you want to be, baby.
Yeah, right. I live about 1.5 miles away from the golf course, and so people figure, the kids figure, hey, we'll just walk to the golf course.
Sure.
And we said, well, how many people are you talking about? And he said 15. And
15.
I was like, oh God, here we go. I don't have a big enough house, right? I have a 3,500 square foot house. I don't have a mansion, right? People think I live in some crazy.
So what are you going to do?
Well, my wife thinks we need to buy a bigger house.
Oh, of course.
Well, here's the problem. I refinanced my house during the lowest interest rate environment in history. I have a 2.5% mortgage for 30 years. I can never sell that house.
Not now.
If I'm going to get rid of it, I'm going to have to rent it out, right?
Absolutely.
So if I buy another house, I'm going to be buying them at a 7, 8, 9% mortgage rate.
Can't do that now.
It's crazy, right? So listen, the lesson here wasn't just this long-winded story about my goofy kid at UCLA that thinks he's a frat boy, but it's to realize that, look, when interest rates are low, you refinance your home. When interest rates are high, it's time to consider refinancing your retirement. And look, we are in this great interest rate peak right now. Interest rates are up. And what that means is you can lock in those newer rates for the long term. If you don't want to be exposed to all of the stock market, there are other options. If you bought an annuity over the last couple of years and it just isn't performing, right? It's not the right thing. Then what you need to do is get a second opinion and find out whether it makes sense to refinance that annuity, to update it, because there are now bonuses that will allow you to bonus out of those existing products if it makes sense from a compliance perspective. It has to be suitable for you. It has to make sense. But if you want to get a second opinion of how you can get out of those annuities that are no longer performing, or if you're taking too much risk in the stock market, we're offering a complimentary portfolio review. Absolutely free. And what we'll do is we'll take a look at what kind of risks you're taking, what kind of fees you're paying. Are your annuities not performing because of when you bought them, or are they just bad products? Give us a call at 833-602-PLAN. That's 833-602-7526. Even easier, if you click on the QR code, that'll take you to assetpreservation.com. For the first 10 callers or first 10 people to go to the website, we will give you an absolutely free portfolio review. We'd be glad to help, but you have to take action.
We began the Asset Preservation Hour by saying the market is going crazy. Things are crazy. You may be in a panic mode. You may be driven to fear. But this may be a time to really calm down and get that second opinion, a free portfolio review. 833-602-7526. You owe it to yourself. And the Asset Preservation Hour continues after this.
We know the market is going to get worse from here. This is the biggest monthly decline in 10 years. People's 401ks took a major hit.
Well, my investments are tanking. My retirement isn't going as planned. I can't believe I let my kid talk me into buying crypto. I mean, what is that anyway?
This was the fourth worst contraction in history.
So how are you two doing?
Your financial future doesn't have to be uncertain. I'm Stewart Willis with Asset Preservation Wealth and Tax. If you have amassed a nest egg, it's time for a financial advisor to help you reach your retirement goals. We are in one of the greatest tax windows in history, so it makes sense to take advantage of this tax discount while you can with your partners in retirement. All of our expert advisors, CPAs, and enrolled agents are fiduciaries that specialize in retirement planning, tax mitigation, estate planning, and more. Plan your retirement right. Call right now for your own complimentary portfolio review and tax analysis.
So glad you're with us on the Asset Preservation Hour with Stewart Willis. I'm Brad Johansen. We've been talking about the adjustments that need to be made and whether or not this is the right time. It sounds like there may be a moment. All right, you took us to UCLA. But by the way, how did the hanging of the TV go? Did you figure that out?
Yes, I hired a great team to do it. So listen, I didn't know what I was going to get myself into there. I let them handle it.
All right, well, let me take you to that. Hiring of a great team. Is this a time to reassess? I mean, this is a perfect time as we towards the end of the year, as we start thinking about it. Can you reassess your portfolio now?
Yeah, I think it's really important because, look, I think people are scared right now. People are looking, and it feels very uncertain. Just remember, from the year 2000 to 2012, the S&P didn't do anything. It went down, went up, went down, ended up in the same place 12 years later. The NASDAQ, it took 16 years to get back to where it was at the end of 2000. At the end of 1999, I'm sorry. So it literally took, 16 years to get back to even there. And it sounds like we're going in through a very similar cycle.
Yeah.
Look, the cards haven't been dealt yet. We don't know how they're going to unfold. But I think it is time to reassess, to make sure, because look, I think, what the people that got scared the most really were the people that decided, hey, I'm going to retire this year or last year or next year. They need to retire. And what they've done is they've looked at their amount that they've put away. They've done their job. They put away all their money inside their investments. And they've been assuming that I'm going to make a 10% rate of return every single year.
Sure.
And then all of a sudden, 2022 hits. And it's a new reality. We had 2 bad years straddling each other, right? 2020 was terrible.
Yep.
Then we, of course, had, 2021 was okay. 2022 was horrendous again. And then this year has been, horrible for conservative investors. So I think that using the historical rate of returns that people were used to in the past is misleading. I think they need to get a new assessment of it, which is why we rely heavily on cash flow analysis to reassess. We use some really sophisticated tax software and financial planning software that looks at your different goals. We call them goals-based planning or cash flow planning, where we cash flow out the rest of your life. And listen, as things adjust, as you take money out, maybe you needed to buy a car, and that changes the calculus on whether you're going to succeed or not.
Absolutely,
right?
it does.
So we can, our technology really helps us take a look at that stuff.
You're a Roth guy. People hear you talking about Roth all the time. We move towards that Roth. First, explain the Roth and why this might be something that people should be looking at right now.
Yeah, so, the Roth is interesting. So in order to understand the Roth, you really have to understand its counterpart, which is the IRA or 401k or thrift savings plan. And in those accounts, you would either get a tax deduction for putting money away, tax deferred, or you don't have to pay taxes on it in the example of the 401k and thrift savings plan. But when you pull that money out, you have to pay taxes on the withdrawal. And look, Brad, I think what happened is that people always were told that your income tax would be lower in retirement, right? You're going to pay less taxes because you make less income.
That's what we're told.
That's the thought. And look, that may or may not be true. Everybody's situation's different. We don't live in a cookie cutter world. Everybody's story is different, right?
Absolutely.
But here's what we weren't told. What we weren't told is that if you defer your taxes now, when you pull out your money in retirement, you are now exposing Social Security to potential taxation when it may not need to be. Because look, what we find out all the time is people take Social Security for granted. They just go and they file for their benefits. They don't think much about it.
Yep.
Oh, I'm going to just file at 62 or 65 or 70, whatever. And listen, we have a really in-depth calculator that can tell people when the best time to file is, and not just to get the most over their lifetime, but to get the most for their situation, because everyone's situation is different. But we do that analysis for Social Security, and what we find out all the time is that people that have filed for their benefits without thinking it through, really heavily thinking it through, is they have now exposed all of that benefit to taxation. Up to 85% of it can be taxable, and it was never intended to be. Well, here's the thing. When you have a Roth IRA and you take withdrawals out of it, if it's been in there for over 5 years, it's completely invisible to Social Security. It's completely tax-free. It doesn't count towards Medicare penalties called IRMA. It doesn't count towards any of these issues for taxation of Social Security. And look, what really scares me is when Bernie Sanders and Lindsey Graham agree on something, right? That's a pretty scary moment.
That's a scary moment.
Right? The most conservative and one of the most liberal, of course. And what they agree on is that higher income folks don't need Social Security is bad. And to me, what that is a dog whistle, kind of like what we heard during Build Back Better, where they're going to tax the wealthy. And remember, the wealthy is just this term that makes sense at the time. Because remember, it's the same thing they said in 1983 when they taxed Social Security for the first time. The wealthy don't need Social Security as much. Let me ask you, if you are married with another spouse here, and you have $44,000 of provisional income, do you consider you're that wealthy? Is $44,000 a year, including 50% of your Social Security, is that wealthy?
No.
Yeah, right? It's certainly not in the Phoenix area, right? You're not wealthy at 44, yet 85% of that became taxable. You know why? It's because they've never adjusted those numbers for inflation. And so what happens is once Congress starts taxing something, it's really hard for them to stop. And in Build Back Better, they started to not even consider taxing income, but also taxing assets. That's impossible. They're never going to be able to figure that one out. Taxing income is easier. So for those of you that have IRAs and 401ks and thrift savings plans, when you start taking that money out in retirement, guess what? You are now the wealthy. You are now those people that are considered wealthy. It's going to be a lot easier to tax you, tax your Social Security, and we think that there's more to come. Because look, Social Security has just advanced when it's looking to become defunct. It's now advanced from 2033 to 2032, okay? It's crazy. So we have 9 years left or so before it's scheduled to be defunct, which means that you could lose up to 24% of your benefit when that happens. That's a big issue here. So I think it's important to have a plan, a tax plan, not just a financial plan, but to also understand that you need to understand how those brackets work.
Do you understand all of this? Have you had a portfolio review? We have one for you free, and now is the time. There are so many things to consider. You don't have any more time to waste. 833-602-7526. Scan the QR code on your screen. Get that free portfolio review right now. Asset Preservation Hour continues after this.
You've got quite an extensive resume. Wow, so many years of management. Bet that was fun. So this job requires basic knowledge of the social media and video platforms, content creation, and SEO. How proficient are you in those areas?
Going back to work after retiring is not ideal. I'm Stewart Willis with Asset Preservation Wealth and Tax. If you have amassed a nest egg, it's time for a financial advisor to help you reach your retirement goals. We are in one of the greatest tax windows in history, so it makes sense to take advantage of this tax discount while you can with your partners in retirement. All of our expert advisors, CPAs, and enrolled agents are fiduciaries that specialize in retirement planning, tax mitigation, estate planning, and more. Plan your retirement right. Call right now for your own complimentary portfolio review and tax analysis.
So glad you're with us on the Asset Preservation Hour with Stewart Willis. I'm Brad Johansen. We've been talking about the markets, then we moved to dealing with some of the Roths. You have just talked about the tax prep and tax planning. What's the difference at this time of year with tax prep and tax planning?
Yeah, so where most people's tax planning begins and ends is during tax season, right? They go in, they file their taxes, they sit with the person for a half hour, an hour, and then they walk out with their tax return. Yeah. And they say, hey, what should I do next year? What should I? And that's kind of what most people see in their tax planning. But we think that during tax season, tax prep season, it's the worst time to do tax planning. Look, these tax people, God bless them, they're working their tails off. They're just trying to get done by April 15th, right? They're just trying to get done in time. So if you're doing tax planning during that time, that's a big problem. Second, look, every time we hire an enrolled agent or a CPA, we have to untrain them and retrain them. It's not because they're not smart. It's because they were always taught to try to save you money now, okay? And I think that that's a huge issue. So what they'll do is they'll look at your tax return and say, hey, Mary, if you go ahead and put $7,000 away into your IRA right now, we'll get you a nice deduction. You want to save $2,000, right? Well, of course I want to save $2,000. So you put away all this money into your IRA. Well, that's the beginning of tax planning, but that conversation should also be had at the end of the year. Now, tax planning season is when we can look back, right? And look, we're in the midst of it right now. Right now is it. It is go time. The next month and a half, we are full throttle for end of year tax planning. And what we do is we take a look at how much income you've had, what kind of gains do you have, what kind of losses. Do we harvest those losses to take advantage of some tax advantages in there to harvest your losses against your gains?
Sure.
To neutralize some of those gains in there, at least from a tax perspective. Maybe that makes sense. And maybe it makes sense to do that Roth conversion that we talked about in the previous season. And so, what you have to do is understand that, once again, we are in one of the most efficient tax windows in history right now. And that tax situation is going away if Congress doesn't act. I'm going to pull up the tax brackets that we have right now, and I want to show you right now. So if you take a look at these brackets here, the blue brackets are where we used to be in 2017. Well, after 2018, we are in that red bracket. And don't pay attention too much to the dollar amounts underneath because those have been adjusted for inflation. But this overlap here is really important to show because what it shows you is that we are in this super efficient window. And look, the argument was that this only benefited the wealthy. But if you understand this, that most of the clients we see are between that 12 and 24% tax bracket right there. And that is scheduled to go away. So if you understand that this Tax Cut and Jobs Act is only lasting another 3 years, or it goes away at the end of 2025, so including the next month or two, we only have 3 years left in
2 years and change.
And if Congress doesn't act, it's going back up. So the goal is to use the next few years to take advantage of this bracket, of these low tax brackets, so that you can create a tax plan for the rest of your life to be able to enjoy it. And I think that's something that people miss out on.
If we're moving towards this, can we actually do something about it now? I mean, when we're looking between October and December to do something about that?
This is it. This is our busiest time of the year. It's to really make sure that we take advantage of these low rates. And so the goal is to see whether or not a Roth conversion makes sense for you or not. And so what we're going to do is something we do once a year here, because it's just a way to stimulate people into saying, hey, let's see if this makes sense. What we're going to do is we're going to issue what we call the Roth Conversion Challenge, okay? And in that Roth Conversion Challenge, what we're going to do is challenge you, the investor, the retiree, the pre-retiree, to see if a Roth conversion makes sense for your particular situation. And what we'll do if you want to take advantage of that, only for the first 15 callers or first 15 people to click on that QR code, we're offering that complimentary portfolio review, and it's going to be part of the Roth conversion challenge. What we're going to look at is to see if it makes sense for you. And if you do that, if you participate in that, and you bring statements in for us to analyze, to do a complete analysis on, what we'll do is we'll give you a $50 gift certificate to Mastro's, the greatest steakhouse here in Arizona. We'd be glad to give you that. So rather than having to go one of these goofy seminars that people go to, right, just to listen to, to get the free food, we'll let you and your spouse or you and your girlfriend or boyfriend go eat on your own, right? So if you're 55 years or older and you have an IRA 401k thrift savings plan, and you want to get that analyzed, if it's over $250,000 in value, we'd be glad to issue you that Roth conversion challenge. And we will take a look at whether it makes sense for you or not. Let's settle it now. Take advantage of this year. We only have 3 years left. Taxes are going up.
I mean, this is a portfolio review time too, as well. I mean, we talk about tax planning, but it's never more important right now to take a look at your portfolio.
Yeah, listen, I think people know they need to get it done.
Yes.
They just don't. It's one of the things we do at Asset Preservation is not only do we do the financial planning and the tax planning, but we do the estate planning as well. So we have, if you have a living trust that you've set up, we'd be glad to analyze that as well. We have attorneys on staff that are willing to take a look at your estate plan, or if you have none at all. Look, we do estate plan. It's the one thing we tell our clients. We say, look, I will be there for the surviving spouse. I will be there for your kids, but you have to do your part. You have to have your affairs in order. And in a living trust or an estate plan is usually a big part of getting that done. And look, we do them at our cost. It's $990 for a single property trust. If you have a single property, if you had additional properties, it's more. We only do those for our financial clients. But if you want to get an analysis to see if it makes sense for you, once again, take action. Let's do it before the end of the year. Take action. We'd be glad to give you a second opinion.
All right. It's time to take a look at your portfolio. Have you looked at Roth at this point? Have you done tax planning? Are you tax prepared? Have you done your estate planning? It's all there for you. This is free, a portfolio review for you right now. And it's never been a better time. 833-602-7526. Or click the QR code on your screen. It takes you to a free portfolio review. Are you in fear or panic right now? Let's help calm you down. Asset Preservation Hour is here for you. We're so glad that you were with us. Take the time. 833-602-7526. Always happy you're with us. Until next time, for Stewart, Willis, I'm Brad Johansen. We'll see you again.